Good afternoon. Happy Friday, September 19th. Mark Milam here, your mortgage professional. So it was Fed week. We all knew what the Fed was going to do at 2 p.m. Eastern Time on Wednesday. Cut the federal funds rate by 0.25%. They did not disappoint. The Federal Reserve the Open Market Committee did vote to lower the Fed funds rate by an 11-1 margin. So there's 12 voting members. 11 of them voted for a quarter point cut to the Fed funds rate. One voting for a half-point cut. That was Stephen Moran. That's the president's most recent appointee as a voting member of the board. And so how did mortgage rates respond? Well, it's interesting when you look at what happened with mortgage rates on the actual day of the cut, which was the 17th. I'll bring you right here to it. Right here, this was one of our worst days of the week, right? And we've kind of been predicting this. A couple of reasons for this. But the big one is really something we like to call buying the rumor and selling the news. You may have heard of that expression. Now, how often in the world of bond trading or stock trading do traders know exactly what's going to happen and when it's going to happen? And so all eyes have been focused on September the 17th, 2 p.m. Eastern Time, because we know that's when the Fed is meeting. And we have futures traders and the Fed itself talking about what they're going to do. So mortgage bond traders or mortgage-backed securities have been moving in that direction for quite a while. In fact, if you take a look at the run-up prior, and I'm going to take it back to a 3-month look back. Let's take a look here. You can see what's been happening with mortgage-backed securities. Remember, green days are good days. Going up is the direction we want. That means the value of the security is improving and the overall interest rate is decreasing. Why was all this happening even though the Fed wasn't cutting the Fed funds rate? Well, it was in anticipation of the Fed rate cut. Okay, every single business day, these bonds and securities are traded, but the Fed only meets a handful of times a year. So the mortgage-backed securities market was positioning well in advance of the Fed rate cut. Traders knew what was going to happen. They were buying the rumor. And then when you get to the news, the actual day of the cut, it's not uncommon to see traders back out of some positions, take their gains, sell on the news, and we see mortgage-backed securities deteriorate a little bit and rates might worsen slightly. And that's exactly what happened. We didn't see a huge upset in the market, but we certainly didn't see any market improvement at the time of the cut. What have we seen since then? Well, jobless claims came in weak. That's not exactly what we want to see. We don't need any upward pressure on wages, which would impact inflation. That would impact the Fed. But relatively tame economic data to finish out the week. And we find ourselves in really good territory from a mortgage interest rate perspective. But back to the Fed meeting. This Fed meeting was particularly interesting because we got the Fed's dot plot projections. Now, this is the Fed holding up the magical Karnak, card to their head and predicting the future about where the Fed funds rate is going to be at the end of 2025, 2026, and 2027. Now, I think 2026 and 2027, that is humorous stuff to think that the Fed has any idea where the Fed funds rate is going to be at the end of those 2 years, but they predict it anyway. But let's take a quick look at some of these dot plots. I find them kind of interesting. Here we can we take a really quick look, and each dot represents a member of the Fed, right, and where they think the Fed funds rate will wind up. Remember, we're at 4.25 right now. There's actually one Fed member who thinks we're going to hike by the end of this year, which is interesting because all of them just voted to cut. But the median here is right around 3 5/8 to 3 3/4. That's where we generally think we're going to finish out. That means another 50 basis points worth of cuts are on the horizon. And there was one lone person, you could probably guess who this is, who thinks we're going to be sub 3% on the Fed funds rate by the end of the year. That would mean an awful lot of cutting that is not likely to happen. We move into 2026, we see a little bit further decline, in 2027 a little bit further decline. I don't take either of these very seriously because that's a long ways from now and a ton can happen in that short period of time. But interesting to get the Fed's take and to understand that 30 days ago when they did these dot plot projections, they were only projecting another quarter point cut through the end of the year. Now they're projecting an additional half point cut. And so the odds or the probabilities of a cut at the next meeting, which is right before Halloween, October the 29th, we can anticipate that the Fed may be cutting again. Let's take a few other things from this meeting and see what we can glean. This is an article that talks about the Fed delivering on what we thought was going to happen, but still disappointing with some of their language. What was some of the language that they used? Well, the Federal Reserve Chairman Jerome Powell called this a maintenance cut, right? Basically citing labor, not wanting to see labor getting weak. But the big story here was how inconsistent the rate cut forecasts were, right? We saw that big wide spread. There's an investor here who's talking about the disappointing thing with the dot plots is they were really all over the place. 6 members said they didn't want to cut. 1 member said they shouldn't have cut today. And then 2 other members said there should be 1 additional rate cut this year. So basically viewing this as kind of a hawkish message. But I'm going to scroll down here and talk about what Jerome Powell had to say at the press conference. He said he anticipates the effects of inflation on good prices to continue to build. Remember, the Fed has a dual mandate. The Fed has a dual mandate of price stability, which they view as 2% annually, and maximum employment. What is maximum employment? Good question. Probably unemployment where it is right now is about maximum employment. Around 4% to 4.2%, somewhere in that range, would be considered maximum employment. He also noted the need for the case of being persistent inflation outbreak is less. He doesn't think there will be a persistent inflation outbreak, which is interesting because he just said the effects of inflation on goods will continue to build. He said tariffs have been mostly absorbed by companies in the supply chain and consumers haven't seen major price increases yet. Interesting. Did say the labor market is softening and we don't need it to soften anymore and don't want it to. And today brings a very different picture of labor market risk, noting it is really cooling off. So here's the interesting part about labor. So we've long been focused on non-farm payrolls and job creation, right? But we have a very different immigration picture in this country today than we did, let's say, a year ago or 2 years ago. And do we really need to create as many jobs when immigration is this restricted as we did before? And the answer to that question is no. That's why you're not seeing that much job creation, yet unemployment hasn't risen very much. What we need to be keeping our eye on are jobless claims. And jobless claims thus far have been held in check. These are people who are filing for unemployment either for the first time or continued. They're doing it for the second or third time. And ultimately, jobless claims have remained relatively tepid. So is the labor market really starting to fracture or not? That's the big question that the Fed is going to have their eyes on. And as we look out to the next Fed meeting on October the 29th, we can see currently a 92% chance that the Fed will cut the Fed funds rate yet again by 1/4 point. There's only an 8% chance as it stands today that the Fed will hold the Fed funds rate static. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.